Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Got a Form 1099-R in the mail and wondering if you have to report it on your taxes? Let's break it down right now. A 1099-R is a tax form you get when you receive a distribution of $10 or more from a pension, an annuity, a retirement plan, an IRA, or an insurance contract. The short and simple answer is yes, you almost always have to report a 1099-R on your tax return. Think of it this way, the financial institution that sent you the form also sent a copy directly to the IRS. If you don't report it, the IRS computer system will see a mismatch. It will see income reported under your Social Security number that you didn't include on your return. This can easily trigger an automated notice, a tax bill, and even penalties. Now, here's the most important part, reporting the 1099-R doesn't automatically mean you owe tax on that money. The key is to tell the IRS what kind of distribution it was. Many distributions are fully taxable. This is common when you take money out of a traditional 401k or a traditional IRA where you got a tax deduction for your contributions over the years. The amount in Box 2A of your 1099-R will usually show the taxable amount. However, many distributions are not taxable at all. The most common example of this is a rollover. Maybe you left an old job and moved your 401k balance directly to an IRA. You'll get a 1099-R for this transaction, but as long as you completed the rollover correctly, none of that money is considered taxable income for the year. But you still have to report it on your tax return. You need to show the IRS that the money was simply moved from one retirement account to another. If you fail to report it, the IRS will assume you just cashed it out and will expect you to pay taxes on the entire amount, plus a potential early withdrawal penalty. Sometimes, a distribution is only partially taxable. This can happen if you made non-deductible, after-tax contributions to your IRA. In that case, your original contributions come back to you tax-free, but any earnings on that money are taxed. The same concept applies to Roth IRAs. If it's a qualified distribution, meaning you've had the account for 5 years and are over age 59 and a half, the money is typically tax-free. But you still report it to show the IRS it was a qualified, tax-free distribution. So how do you report it? It's usually straightforward. Your tax software will have a specific section for 1099-R forms. You'll just copy the numbers from the boxes on the form into the software. The software then asks questions to figure out how much, if any, is taxable and places the numbers on the correct lines of your Form 1040. The main takeaway is not to ignore it. The bottom line is this, if you receive a Form 1099-R, you must report it on your tax return. It doesn't matter if you think it's taxable, non-taxable, or a simple rollover. Reporting it is how you tell the IRS the full story and avoid unnecessary tax bills and headaches down the road. I hope this cleared things up for you. Thank you so much for watching. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel for more simple explanations of common tax topics. Remember, this is for educational purposes only, and you should always consult with a qualified tax professional for advice on your specific financial situation.